Hello traders, this is Jay Temez, and I'm here to show you some different types of indicators and tools that you can use to help your investment strategy. So I have here an ETF of the S&P 500. So this is what we use to track the general direction of the entire stock market. And I want to go over some of these indicators that I have up. These are really easy tools that you can go and use on tradingview.com. You simply sign up and it offers you all these advanced charting tools so that you can look at any index, any stock or ETF or even cryptocurrency. So I have these lines. You see these colored lines here. I have the blue, the yellow, the red, and the green. So we've heard this term called moving average. These are 4 different moving averages that I have on the screen, and what that does is it tells the computer to, or the software, to plot a point so many bars backward and give us that average plot. So to illustrate this point, what I'm going to do is, first of all, let's go ahead, when you're looking for this indicator, what you would do is go up here where it says indicators. I have a daily chart. So now I'm going to click on indicators, and I'm going to go find the moving average ribbon. That's my favorite one, and that gives you 4 moving averages that you can then define. So if you select moving average ribbon, of course you can type it up here and look for it. So you go moving average ribbon, and it should come up, ribbon. Here. So then you'll select that. It will pop up on your chart. Of course, the default settings will be different, so you want to go here, and there's a little gear that says settings. I'm going to click on that, and then I'm going to use all EMA, which stands for exponential moving average. We'll get into that in a different video. You can it'll default probably with SMA, which is simple moving average, but we're going to be using the exponential moving average. So I have mine set here. Let's see. Let's make this 20, and the next one 50, and the next one 100, and then the last one is 200. And what I'm going to do is go into the styling, because I want to illustrate my point how this works. I'm going to go into the style, and I'm going to select each moving average, and it's going to give me my choice of ways to plot, and I'm going to select circles. So I'm going to do that for each one. I'm going to select circles. And this is really neat because this will help you better understand how this works. So instead of the lines now, we see these dots. And when I have the blue, which is 200 period moving average, what that's saying is from my current bar, measure back 200 bars, and each bar has a correlating dot. So go back 200 bars, and I want you to take the average of all of those 200 bars from now backward 200 bars. Take the average and plot a dot. And that's what it's doing for every single bar. It's going back and plotting 200 bars backward, averaging them all, and plotting a dot. So a lot of times when you see moving averages, you'll see a line. Well, your software is merely taking those dots and connecting them together, so it looks like a line. But this way you can better understand what that moving average is doing. So I have the 200 period moving average, the 100 period moving average, the 50 period, and the 20 period. So now I can go back into my settings now that you understand how it works, and I'm going to make them all lines again. So it'll just look a little cleaner. Go back, select lines. Okay. So what do we use the moving average for? Many people use it for many different reasons. I like to use moving averages to help determine the trend of the market. So as you can see, if I go back, starting, from a long time ago, you can see all of these moving averages are all angled upward, and you can see price was moving upward along with the moving averages. So now if we see the alignment where the 20 period, which is green, is above the 50 period, which is red, the 50 period, which is red of course, above the 100 period, which is yellow, and then the 100 period above the blue 200 period. That is what I like to call moving average alignment. And here we have a perfect moving average alignment, all trending in the upward direction, and that's indicative here, demonstrated by the 20, 50, 100, and 200 period moving average, all on top of each other. You can see here where the 20 period crossed under the 50 period moving average. Well, that might have been an early sign that we were turning around. I wouldn't say if we go to the right edge here, and you can see where that cross happened. I mean, there might be speculators that see weakness in that upward trend now. It's starting to show its cracks. So, but of course it recovered, and we had moving average alignment again until right about here. So here you can see a tremendous downturn start to occur, which was sometime in early 2022, sometime in January. So we had a big drop in the market. The 20 period crossed under the 50 period. It also crossed under the 100 period, which really probably had a lot of investors concerned about the stock market. So we had a little mini crash or correction, you might say. And now we see this is really a big sign here. So you see price break under this 200 period moving average, and that's a big deal to people that are all watching the stock market. We see it bounce back up. It tests that 50 period moving average, and then it breaks right back down under the 200 period moving average. Now, as we go forward, you can see that's kind of where we are. We're kind of hovering under that 200 period moving average as of today, April 26th, 2022. So anyways, hopefully what happens is the market recovers, but you just never know. We could be entering a bear market territory or a sideways consolidation, but I use the moving averages to help me determine that. Right now we might be entering a consolidation where price bounces above and below the 200 period and all the moving averages. Who knows how long that'll go on. So now you can see underneath my chart I have these volume bars. So what I like to use volume bars for is to determine the amount of trading activity that is coming into the market. So a lot of times when we see a big move, let's just say this downward move, it will be accompanied by a larger amount of trading volume, and each bar that is painted has a corresponding volume bar that measures the amount of trades within that bar. You can see it's red or it's green based on the majority of trading activity. If there were more sellers, then it would be red. If there were more buyers in that bar, then it would be green. So it just shows which activity dominated that bar. So that's what I like to use volume for. It's important when you're using it for investing or for trading. You want to be able to gauge and frame the market. That's what this helps me do. I'd like to take a moment to talk about that. So when we use moving averages and indicators, really what we're doing is trying to frame the market. And an example of that would be if you're driving down the road and you have this center line that's dotted and it's yellow. That is an indication to you, a driver, that you need to stay in your lane, because on the other side of that dotted line, that yellow dotted line, is oncoming traffic. So you don't realize it, but you pass oncoming traffic traveling at 30 miles an hour, 40 miles an hour, sometimes on back roads 50 miles an hour, and you're really only about 8 feet away from that oncoming car, which is dangerously close. So that center line is kind of a false sense of security. But if you take away that line, boy, something interesting happens. If you're on a back road, anywhere, you suddenly find a road that doesn't have lines painted on it. You do an interesting thing. You hug the right-hand side of the shoulder of the road, because you don't know where to gauge the center of the road as easily as when that line is painted there. The guy, or person I should say, coming in oncoming traffic is doing the same thing. They are hugging the opposite side of the road, their right shoulder. And when you pass each other, you realize you've given yourself a huge amount of space, sometimes 20 feet between the two of you, because you just want to make sure you don't accidentally bump into that guy and have a collision. So that's an example of how we use indicators much like those lines painted in the road. We use it to gauge and to frame the market so we can tell where we are in, relatively speaking, to that market. So now let's go ahead and take a look at another popular indicator. You see down here in the bottom pane, I have what's called the stochastics. Now we've heard a lot about stochastics. Now if you bring that up, you simply go to indicators and type that in, stochast. So you'll see it comes up. You click on that. Just accept the default settings. It's set for 14 periods. So what we use this for is to try to determine, it tries to determine overbought, which is in the bottom areas, top areas, overbought areas, and oversold areas underneath. So you can see anything over this line here of 80 would tell us that this might be an overbought area, and it might actually have gone too far and needs to kind of spring backwards now and sell off. And the opposite of true in the bottom end. If we start breaking below this 20 marker, this might be an indication of oversold areas, and the market might then take a turn and pivot back up. So we can use that when we're determining, when we want to get into a certain stock or an ETF or any type of index or crypto. We want to be able to get in it at a good wholesale price. I wouldn't really want to buy any stock on the S&P that's way up here at the top. I wouldn't want to be buying that expecting it to go up, because if you look here, we're at the top end of a pivot. You can see these pivots that have occurred. Well, I'm on the top end of it, so let's go to the right edge. Let's say I was looking here at the market on this given day. I wouldn't want to be buying up here. I would probably want to wait till the price comes back close to this 50 period moving average and then think about getting in at a better wholesale price in anticipation of going upwards again. So if you look at the stochastic, you can see it's kind of high. It's above 80, which means it might be overbought. So maybe I want to wait for that to come back down on one of the pivots closer to the 50 period and closer to where the stochastics is on a bottom end of its range. So those are a couple of tools. Now, talking about stocks, we like to use the S&P. I like to use the S&P. It's SPY here. It tracks the S&P. It's an ETF. You can bring it up in your trading software or on TradingView. And I like to use that to gauge the entire market, because let's say I am interested in buying Amazon stock. I certainly would not want to be buying that stock when it's way up here, when the S&P is way up here at the top. I would want to wait to buy that. Like I said, I would want to buy any individual stock when the S&P in general is at its oversold levels, the bottom end of the RSI and the bottom of its pivots, rather than buying when it's way up here at the top, because chances are, it's not guaranteed, but it seems like the RSI is saying, and the pivots up here are telling us that maybe we're overbought up here and it's going to come down against us. Granted, you want to buy something so you can own it. You're going to be maybe a swing trader. You want to hold it for longer periods, or you're a value investor. You want to own it, for a long time, for years, and consider it part of your retirement. Well, why not get in at a wholesale price rather than overpriced, right? We always look for sales whenever we go shopping. We want to do the same with stocks. We want to buy them at closer to wholesale or at a discount, right? So this is something that's interesting. You can take any stock, speaking of, and layer it over the S&P, or better yet, let's do this. Let's layer the S&P over it. So I'm going to take, let's go Amazon, there it is. Let's pop that up here. Now this is a NASDAQ stock, so I don't know if I should be doing it this way. Let's go ahead and pick something that actually would be in the S&P stocks. Let's go. I know one by heart. This is the Huntsman. Oh, that's a nicey. Let's try another one. Let's go. HPQ. I think that one is. Wait, actually, no, that was an S&P stock. Okay, so let's go ahead, and now we have this HP, Hewlett Packard. So we can look and say, well, I really want to buy Hewlett Packard. I like the company. I like what they do. They have good price to earning ratio and all this good stuff. So now I want to see where it sits and how closely it follows